Welcome to ForexTV.com's PM Exchange. It's Tuesday, January 8th. I'm Remy Hoki. Today we're joined by Win Thin, Senior Currency Strategist at Brown Brothers Harriman. Good afternoon, Win.
Hi, Remy.
Happy New Year.
Same to you. Thanks for having me back.
Thanks for coming on the show today. Well, in today's session, we saw U.S. equities move in and out of positive territory, and we ended today's New York session with triple-digit declines for the Dow, and the other major indexes also down over 1.5% on the day. But as a result of the decline in equities, we saw dollar-yen as well as the yen crosses move in sync with equities. So as we head into the Asian session and come into the morning session here in the U.S. tomorrow, if you could briefly give us your forecast for the yen.
Sure. Well, right now the equity markets are wrestling with the U.S. economic outlook. We've had some very weak data out this last week, but that's on the other hand, that's fanned expectation that the Fed will cut rates aggressively. Some are betting on a 50 basis point cut at the end of the month. So there are conflicting forces at work. That some that believe that the Fed will continue cutting rates and that will support the equity market, and yet we're faced with really a sharp slowdown in the U.S. economy as Q4 ended and we moved into Q1. So those factors will continue to play out over the next several weeks. We're not going to know the answer until January 30th when the Fed meets. But with that said, the yen is certainly going to gain during these bouts of what we would call risk aversion. Over the last several months, there's been a very high correlation between the yen, which gets stronger when the equity markets tend to fall. And so far this year, that's held up. So to me, there's no real fundamental story for a stronger yen besides this risk aversion. To me, we have the Bank of Japan not being able to hike rates. Rates will remain at 0.5% for most of this year. Equity market is down quite a lot, and growth is slowing. So to me, that's not a recipe for a stronger yen. It's really a recipe for a weaker yen. But for now, the risk aversion play seems to be in force.
Well, while we're talking about central banks and also rate differentials right now, you mentioned your expectations for the Fed, but we also had the BOE and ECB rate announcements coming out on Thursday morning. So if you could give us your expectations for those central banks heading into the rest of '08 and how you see this weighing on the respective currencies of the euro and sterling.
Sure. Well, the ECB remains hawkish, and I guess with their mandate really solely focused on inflation, they have to be, because inflation right now is above their comfort zone. Money growth is also quite strong, but on the flip side, there are already signs in some of the weaker countries, for instance, France, Italy, that growth is slowing sharply. Germany remains, actually the German economy remains pretty robust, and that's sort of helping the ECB resist these pressures. But at some point, I don't think that Germany can resist the sort of the headwinds on the global economies. So we expect the ECB, while they're hawkish now, to eventually cut rates around mid-year, and that will help turn the dollar around. We think the dollar outlook over the near term remains very rocky, very vulnerable to expectations of lower Fed interest rates, but that should turn as the year progresses. With respect to the sterling, the Bank of England, we think it's possible they cut. They just cut rates in December, but 2 in a row, it might be a little tough, but at the same time, it can't be surprising. We know from the Bank of England minutes from December that they discussed an even larger cut than the 25 basis points. So they are sending out dovish signals. So it is I would say a 50-50 chance that they cut 25 basis points this month. If they don't, the market expectations will simply build that they're going to have to cut in February for sure. That's really keeping a lid on sterling. It's bounced back a little bit today, but overall, it's been one of the worst performers over the last several months, and for good reason. The UK economy is suffering from very much the same problems that the U.S. is. Bank of England is cutting rates. Sterling is overvalued, so we think for instance, 2 per dollar is going to be a very formidable barrier. And in fact, I think the sterling will revisit the '07 lows of around 192 against the dollar.
Well, you've given us your longer-term outlook in terms of fundamentals regarding the euro and the sterling. But if you could give us your take on euro-dollar and what ranges you expect to see the pair trade in the upcoming sessions.
Sure. Well, near term, I think we'll be in sort of a 146, 148 range. There's been some upside, downside tries, but those levels have sort of held over the last several days. But I think eventually we're not that far from the 150 target that everyone's really had their sights on since last year. So, I do think we'll test that over the next couple of weeks. we could even overshoot up to 150, 155. But again, everyone's so focused on the bad U.S. stuff right now. But eventually, I think the markets will realize that Eurozone and UK both are going to suffer as the year progresses. So that will help the dollar turn around. But near term, it looks pretty dicey.
Okay, and I also do want to take a moment to mention that in today's New York session, we saw commodity prices rally again, with gold hitting a new record high. But if we could talk about the commodity currencies and how we've been seeing this commodity rally play out in dollar CAD as well as Aussie dollar. So starting out with dollar CAD, do you have a bullish outlook for the pair?
For the U.S. dollar, yes. I think that the rally in the Canadian dollar over this past year is really overdone. Canada has great fundamentals, but nothing really justified the sort of amazing move that we saw in the Canadian dollar. So at this, the most recent sessions, there's been a growing realization that the Canadian economy, while it's strong, is going to suffer probably the most from a U.S. slowdown. Mexico and Canada are really running the front lines. 85% of Canadian exports go to the U.S. Commodity prices will help. High commodity prices will help limit Canadian dollar losses. But we have the Bank of Canada already cutting rates in December. They expect to cut rates again this month. So between lower interest rates in Canada and expectations of slower Canadian growth, I think the Canadian dollar will really trade with a weak bias. I think we'll probably go back and retest the 108 level high that we saw back in, I think, August of this year. We may see one more try underneath parity, but to me, the outlook for the Canadian dollar seems on the bearish side.
Okay.
I should also add, it's interesting for me that there seems to be a disconnect between all these global recession fears and high commodity prices. If markets are really serious about the U.S. going into recession, Japan obviously is flirting with a slowdown. European economy is slowing. It's hard to justify why commodity prices remain high. So I suspect that the global economy may be in better shape than we're giving it credit for. So the commodity prices are likely to remain high. We have China and India obviously still growing very fast. So commodity prices are likely to remain high. That's going to benefit, as you mentioned earlier, Canada, Australia, New Zealand, South Africa from the high gold prices. So even though we're seeing this bout of yen strength, I do think that's temporary. I think the high yielders will come back into play. That's going to favor commodity currencies as well.
Well, since you gave us a really great overview of the so-called commodity currencies, if you could give us your forecast for the Australian dollar against the Japanese yen in the near term.
Well, if over the near term, I think the yen is going to remain firm on the crosses. Again, that whole risk aversion play is there. But overall, you can look at the numbers out of Japan on the capital account, and you see that the Japan investors are still chasing yield. The weekly numbers out of the MOF still show a fairly steady and sizable outflows out of Japan into what I believe to be the high yielders, New Zealand, Australia, and some of the other, even Brazil. So that should, I think, reassert itself. But for now, the strong yen, it's hard to argue with that, with this correlation with the equity markets. And given these really heightened recession fears, that's probably going to continue for the near term.
Okay, and before we wrap it up for today's interview, given what's going on in the global market, economic concerns, recession fears, for Forex traders and investors in the Forex market right now, where do you see the most opportunity?
Well, I still like the emerging markets. I think despite the weakness that we're seeing in the U.S. economy, many of the emerging markets are really enjoying domestic-led growth. Brazil, China, India, to a lesser extent Russia, because that's a big oil play. South Africa has high interest rates. So I do think all the high-yielding currencies will perform well in 2008. Again, not near term. We're seeing the carry trade is not quite back in favor. But once volatility subsides, I think investors will pile back into that.
Okay, Wen, thank you very much for your insight and analysis this afternoon.
Thanks very much.
This has been your Forex News with Wen Thin from Brown Brothers Harriman. Next up, we have your equities and commodities wrap-up for the day. U.S. stocks saw steep losses at the end of the session, with the Dow Industrial sliding over 200 points. In another erratic session, investors worried about the latest bankruptcy rumors at Countrywide Financial Corp. Meanwhile, talks of AT&T seeing a slowdown in its consumer businesses added to jitters over the U.S. economic outlook. In today's economic data, the National Association of Realtors said its pending home sales index fell a bigger than expected 2.6% in November. At the closing bell, the Dow Jones Industrial Average tumbled 238.42 to end at 12,589.07. The tech-heavy Nasdaq declined 58.95 points, or 2.36%, to 2,440.51. And the S&P 500 fell 26 points, or 1.84%, to close the session out at 1,390.19. And taking a look at the fixed income market, U.S. Treasury bonds saw a reversal from earlier losses and ended mostly unchanged for the day. The benchmark 10-year Treasury note fell, yielding 3.84%. The 30-year long bond was down with its yield at 4.36% from 4.35% late yesterday. And the 2-year note was up, yielding 2.75%. And in energy, NYMEX crude oil futures gained ahead of tomorrow's EIA inventory data. Also, threats of violence in Nigeria's oil region weighed on crude prices. There are expectations for an 8th consecutive decline in U.S. crude inventories. At the end of today's session, February crude gained $1.24 to close at $96.33 a barrel on the NYMEX. In other petroleum products, February RBOB gas added 4.41 cents to $2.4739 a gallon. February heating oil added 4.28 cents to close at $2.6363 a gallon. February natural gas futures added 8.1% on the day to close at $7.96 per million BTU. In the metals complex, we saw a rally in gold futures today. Gold surged to a record high and closed above $8.80 an ounce for the first time. The most active gold contract hit an intraday and all-time high of $8.84 an ounce. February gold ended the session at a record, soaring $18.30 to settle at $880.30 an ounce. In other metals, March silver rose 52.5 cents to close at $15.08 an ounce. April platinum rose $29.40 to close at $1,560.50 an ounce after hitting a high of $1,562 an ounce. And March copper rallied 15.75 cents, or 5%, ending the session at $3.2985 a pound. This afternoon, we're joined by Derek Fry from ONF Futures and Options. He'll give us his outlook for energy and metals futures.
Okay, recapping the action we saw in the energy and metal sectors today, we saw definitely day to the upside really across both of those markets. We saw gold push to an all-time new high, just a bit above 875. If you'll look at the daily charts of gold, you can clearly see that we've broken out from a very almost textbook classic bull flag pattern. And Technical Analysis 101 teach you that the expectation for the move, now that it's broken out, is roughly equal to the flagpole itself, and the flagpole is roughly 200 points. So we broke out at 850. That gives us a target of 1050. So it does look like we should see the $1,000 level tested in this move. And I'm not trying to say today, tomorrow, this week, or even maybe this month, but certainly Q1 and at the very latest Q2, we expect to see gold touch that mythical $1,000 level and beyond. Really, at this stage in the game, we would be advocating buying any pullbacks that you can, cautiously, of course, because we are at extremely lofty levels. Moving over to the energy sector, we did see crude oil break down yesterday. We saw it stabilize and firm today ahead of tomorrow's inventory report. We advised our clients that our models expected crude oil to be trading between roughly 95 and 105 for the next 7 to 10 trading days. So, we're buyers on the dip that we saw yesterday and a little bit today, early today, and really looking to target a move back to about $100 a barrel at least, possibly as early as this week. If not by this week, certainly by the end of the month.
That was Derek Fry, head trader at ONF Futures and Options, with his commodities commentary. And that's it for today's edition of PM Exchange. I'm Remy Hokie. Join us tomorrow morning for your latest news update right here on ForexTV.com. Have a good night.